Good evening from the UK, but good morning, good afternoon, good night, perhaps from wherever you are joining us tonight. My name is Viola Polakowska, and I'm the Associate Director of Alumni Relations here at the Business School. And it's my great pleasure to welcome you to our event today. We've got alumni joining us from over 100 cities to this special network, our OBE network event, as part of a Meeting Minds global event hosted by the University of Oxford. We've got alumni joining us from as far as Scotland and New Zealand and from countries in between, representing our truly global and diverse alumni community. I'll shortly introduce you to Jimmy, our host for tonight, who will be leading on our session on financing the transition, which will focus on JPMorgan Chase and the pursuit of a sustainable future, with another alumna, an MBA alumna from 2008, Neha Coulon, who is Global Head of ESG Solutions at JPMorgan Chase. Both Jimmy and Neha will discuss the firm's role in leading the way towards a low carbon future. In the meantime, I just wanted to give you a few housekeeping points. You will see that we are currently sharing a slide detailing the Zoom logistics of the session, which will include some feedback from you. So please get your mobile phones ready for QR codes or check the chat box for the link to our quick survey. This should now be on your screens. So now that that's all clear, just leaves me to welcome our host, Jimmy Gia, Managing Partner at the Gia Group, who is a strategist working in climate finance, helping corporations shift investments into greening their infrastructure. He's also the ESG venture partner at Pi Labs, Europe's largest and most active PropTech VC company. Jimmy received his BSc and MS in material science from the Massachusetts Institute of Technology and an MBA at Said Business School. He's actually back at Oxford, so he is continually learning. He literally flew in a few days ago, and he's undertaking his DPhil at the Smith School, focusing on creating an energy version of the balance sheet. Without further ado, over to Jimmy, and I hope you will enjoy the session.
Great, Viola, thank you so much for that introduction, and great to see so many people joining this webinar today. My name is Jimmy Gia. I was SBS 2008-2009 and currently doing a DPhil in sustainable finance, climate finance at the Smith School. As you hear from my background, I'm an entrepreneur. I also teach at a couple of MBA programs as well as a writer. And over the course of today's interview, for those of you who have come to these before, know that you feel free to enter in the questions live within the Q&A or the chat box, and I will moderate those questions as they come up. We are a broad group of people here today. We 72 of us already on the call. And so why don't we start by getting to know each other a little bit. And we will start with a couple of Mentimeter polls just to see where the different interests lie when it comes to ESG. So as that comes up, can you please either click on the link in the chat box or go to the Mentimeter site and enter in that code? And what is your top ESG priority for your company that you are working with right now? And let's put that in. And as we gather that on the Mentimeter, we will be able to see what these priorities and these surveys come up. Answers are coming in. Carbon, reputation, doing the right thing, cultural diversity. Very good answers. Diversity is, sustainability just popped in there. Carbon is still growing, and so is diversity. Climate. And it's fascinating to see how the different attributes of ESG comes together, whether it is the carbon related ones and the environmentally related ones to the socially related ones like the diversity, inclusion, and social justice answers. And as I'm sure we are all aware as ESG professionals, it's really hard to conflate the two together as well as keep them separate and deal with them separately. And in today's conversation, we will try to explore a little bit of that. Answers are still coming in. Let's give it a couple more seconds. Great. Why don't we move to our second one? Same thing, but now instead of talking about priorities that you're working with, what are the biggest risks that your companies face when it comes to this ESG profile? Carbon footprint, carbon footprint, climate policies, government policies are a big risk. That's a very good one. Understanding that the different policies are changing and the different policies are global. And again, reputation comes up. Again, inclusion comes up. Funding, very good. Carbon footprint. And it's interesting and optimistic to me to know that regardless of where we sit in the world, everyone is dealing with a very similar set of issues. So yeah, thank you very much for all of that information. Really good exercise, I think, to get us all participating and used to the systems. And why don't we switch over now to welcome Neha? So as you probably read in the background into today, Neha Coulon is global head of JPMorgan's ESG program and advisory efforts, and does basically everything ESG related. And prior to that role, she was part of the sustainable finance team. She's helped create the SDG linked finance commitments, as well as the sustainability platform, did her MBA at SBS, did a Master's of Finance at Princeton University, started off as an electrical engineer, but perhaps most importantly, she's the only global head of ESG at any major bank that I've ever shared a drink with, because we are classmates. And so Neha, thank you so much for joining us today.
Hi, Jimmy. Thank you for having me. Really happy to be back.
Great. So let me just start off actually with a pre-MBA question. Because prior to the MBA, you were working in commodity sales, you were working in M&A, head of capital. Where within your career did you make the shift into ESG?
So I made the shift into ESG in my mind first, before I did it in my career. So as you know, I grew up in India, and I saw following the changes in 1991, following the balance of payment crisis, when India was, expected to open up. I saw what unchecked economic growth without adequate environmental and social standards can do to a country. And so for a long time, I had this idea that I wanted to do something about it. I didn't quite know what, and I didn't quite know how. And my time at SBS was really impactful, because I met a number of colleagues who were involved in some way, shape, or form, whether it was in social entrepreneurship, whether it was in impact investing, but who were trying to marry the financial background that they had with a much more impactful, ESG focused, social outcome focused background. So that was the first time I really saw how I could actually use some of my background to actually drive positive outcomes. But again, there wasn't an immediate opportunity that I saw. And so post SBS, I ended up working at JPMorgan on the trading floor in commodities, quant, systematic strategies. But I still kind of had that nugget in my mind. About 5 years ago, JPMorgan wanted to create a much bigger, much broader sustainability strategy. They'd already been part of the sustainability work, starting from as early as early 2000s. We created our Office of Environment Affairs, I think back in 2003. And since then, we have been doing environmental and social due diligence on many of the financings that we've done. But the idea was to just, in a much bigger, comprehensive, holistic way, create a sustainability strategy that looked at not just what we were doing from a risk perspective and understanding the environmental and social risk, but also from an opportunity perspective, and how we were going to be able to incentivize or help drive more green businesses and businesses that specifically help with climate change. And so we created this sustainability strategy and that was manifold, and that looked at both our operational footprint and decreasing our carbon footprint as a corporation, driving change with our clients, decreasing and understanding the environmental and social risk that we had, but also included other pieces around policy engagement, for example, and employee engagement, to make sure that we were coming up with an end-to-end strategy. So that was the opportunity, and I raised my hand, and that's how I managed to make the transition from a very kind of trading floor financial role to a much more corporate, much more broader JPMorgan sustainability role.
And from that perspective, did any of the skills that you picked up on the trading floor transfer over into what you do on a day-to-day in the ESG role?
I think so. I mean, I'd like to think so. I think what is helpful, and this is the one piece where I very quickly understood what was happening in this kind of very changing world post-Paris Agreement, was that there were a lot of people who had trained up in the sustainability part of the economy, and they knew very deeply what the underlying sustainability issues are within various sectors, et cetera. And they typically either came from policy backgrounds, they came from NGOs, they came from consulting and risk backgrounds, but they did not have financial understanding. So when they would try to translate that for bankers, they were just not able to communicate because they didn't speak the same language. And they didn't understand sometimes what the regulatory challenges were that would prevent their great ideas from actually being implemented. And so I think having someone with a financial background just helped that translation exercise between the two sides. And I think that's where I'd like to think, that financial background helped. And there was a lot of learning on both sides, of course. But I think that was really key.
Yeah, it seems like the theme of financial translator is coming up. We see that in the comment as well. From your perspective then, now having worked in sustainability and as well as within the core of finance, how do you tend to frame then this ESG issue, this sustainability issue from the bank's perspective?
So I think of it in three ways. I think in terms of risks, I think in terms of opportunities, and I think in terms of impact. So, and I think that's the kind of trifecta that most corporates are thinking about and are being pushed to think about. So, Jamie, our CEO, feels quite strongly about the purpose of a corporation and came out as the chair of the Business Roundtable with a statement of the purpose of a corporation. And I think that is increasingly important because the social license to operate for corporations, which I'll say in the last few years, has really made a resurgence, is quite important. Understanding, why do you exist? It's a question that often got forgotten, because the answer used to be, I exist to make money for my shareholders. And that question needs to expand and has been forced to be expanded, because if that is the only answer, then the corporation is not going to survive for very long. And we're a very old corporation, and we want to be around for the next 100 years. So I think that is a very crucial question. Related to that question is the risks and opportunities, because that is really key. How do you future-proof your company? And when I talk to our clients across the oil and gas, the metals and mining, cement, building materials, auto, many of the sectors, the question of future-proofing your business keeps coming up. And that's where sustainability is increasingly key, because as regulators have really picked up and policymakers have really picked up on this ESG agenda, increasingly we are beginning to see both financial policy and industrial policy start to impact decision-making. And I think that it's really important. And that's where you kind of see this risks opportunity piece really come together. I think the most stark example probably in recent times is with the auto sector, with the new emission standards in Europe, for example, at 95 grams of CO2. Pretty much overnight, many of the auto manufacturers now have to worry about paying a fine if the average emissions of their fleet are above that number. And so we saw the tie-ups, for example, the likes of Tesla and Chrysler coming together to be able to pool their vehicles to make that happen. But that's really lit a fire under many of the OEMs in Europe to decrease the carbon intensity of their fleet. And we're seeing a similar piece happen within the consumer goods space with the 2030 ban on single-use plastic. We're seeing that in the chemical space with under the Green Deal, the view that all toxic chemicals will be banned in Europe starting 2030. And of course, we've seen that within the utility space with the shift from coal to gas to now renewables happening.
Yeah, and so we can think of these risks, we can think of these opportunities, and we can think of these impacts, and that's very much aligned with how TCFD thinks and talks about their language. And we're starting to see the Task Force for Climate-Related Financial Disclosures really becoming much more predominant than it has been in the past. I think it's 25% now of companies are reporting to TCFD. When you start thinking of these risks, and you were talking about different real economy verticals, right? The cement, the steel, the transportation. Do you see the regulations being imposed onto those different sectors, I guess, aligned as it goes up through then to the financial sector to be able to help underwrite loans, or are there sometimes there might be conflicts within how these disparate sectors are getting regulated and their own carbon goals and what they have to perform to?
I don't see a conflict. I think in terms of influence, I think of, again, I tend to think in threes. I think of what is actually going to influence corporate behavior. Number one is regulation. Or the fastest way to influence corporate behavior, let's say. Regulation, certainly. Investors, so what investors want. And then the third piece is competitive behavior. So what your clients want, what your other competitors are doing, and how do you fit in that equation. What we're seeing on this topic of specifically climate, let's talk about climate for a second. What we are seeing is, of course, regulatory push. So in the UK, for example, starting next year, all premium listed companies will need to have mandatory TCFD disclosures. The expectation is Europe is not far behind. That's going to happen in Europe as well, under the review of the non-financial reporting directive. And now in the US also, they're talking about mandatory climate risk disclosures. So I think there is certainly this kind of very strong regulatory push. There's enough flexibility built within the current regulation that allows companies to adapt to what fits for them. Because the challenge with climate and regulation has been that we live in a very complex real economy. And it is really, really, really hard to create a one-size-fits-all. approach. And so there's enough flexibility that is built within regulation. And right now the focus is on disclosure and standardization. And over time, that will change and it likely become stronger because the EU especially likes the comply or explain approach. So they typically start regulation with, please do this and tell us why not if you can't do it. And then over time, we saw this with MiFID. We expect to continue seeing this with other regulation. So I think that's certainly something that's going to happen. What's interesting for us is actually within the ESG space, we saw the investor piece really come before the regulatory piece. So we saw a lot of focus from investors to push companies to do more, even before the regulation was finalized. The regulation was in talks, but it hadn't been finalized. And a lot of this was because of the large asset owners, especially within Europe, and there are few in the US and there's few in Asia, who really started to push companies and started to push their own asset managers to do more when it came to incentivizing capital flows that help with climate change. And that investor push, we've certainly seen that at JPMorgan across our client base. And we've seen that, with our own corporate. But that investor push is really, really important because that's what can really drive change. And then the final piece, which is around competitive forces and what the clients want. In many of the sectors, that's becoming increasingly important. So consumer goods is a sector that generally doesn't get talked about much when we're talking about extractive industries and climate change, for example. But there was a recent report by NYU Stern that said, sustainability marketed products are growing 5 times faster than conventionally marketed products. And so from a competitor perspective, for many of the industries, it's now becoming a competitive advantage as well.
Yeah, that evolution has taken certainly a long time, but it's good to know that there's enough data to be able to see some of these interactions. And speaking of regulation, what about the EU taxonomy that's being developed today? It's a taxonomy about the different types of renewable, the types of investments that will qualify as sustainable investments. And are you seeing investors having an appetite for the classification system that the EU is going after?
So it's, I guess it's less a question of appetite. It's a classification system where the initial worry was that it is going to become very niche and unusable. So there's a tremendous amount of work that has gone into the creation of the EU taxonomy. But the view was that it was going to become so onerous and so difficult and so niche because it was dark green. It was very dark green. And what it was going to do is potentially create a subset of funds that were focused on very kind of thematic funds that were focused on dark green, but it was actually not going to impact the market. It was not going to impact the broader market. And like with a lot of other EU regulation that sometimes has not gone down well, the bureaucratic disclosure piece becomes so onerous that people just say, okay, this is just not something I'm going to do. I'm just not going to do it. It's too hard. And there's certainly a risk here. The way the EU has kind of tackled that problem, because it was raised early on that there is a potential that might happen, is to start thinking about how they are going to enforce it across all funds. So if it were EU taxonomy by itself, I would worry that it would become a niche, and a lot of work that went in was very well intentioned, but would not actually be able to see the light of day in any mainstream large way. But it is not in vacuum. I think that's the important piece. When you combine the EU taxonomy with the expected corporate disclosures, i.e. corporates needing to disclose what revenue or CapEx, OpEx is from taxonomy compliant activities, you combine that with investor disclosures, whether they are kind of big picture disclosures around how ESG is incorporated within their funds, or detailed disclosures around what percentage, for example, is taxonomy compliant, that then starts to get teeth. Because what we know is if last year is any example of what we expect the future to look like, coming into last year, the view was ESG was going to die. ESG investing hadn't been through a full business cycle. And in a recessionary environment, Companies were going to focus on survival. ESG was a nice to have. It was going to fall by the wayside. The opposite happened. Asset flows into ESG funds, so asset growth was up 96% last year. It had been growing at about 20-25% post-Paris. Pre-Paris, it had been growing at about 9 to 10%. So there's been a paradigm shift. There was one paradigm shift that happened at Paris. There's another paradigm shift that happened with COVID. And we saw a tremendous amount of asset flows into green or climate-focused funds. So if you look at, the iShares Clean Energy ETF, which is the largest clean energy ETF, that had about north of 5 billion of inflows just last year. One ETF. And so what that means is you saw this massive run up in green stocks coming into especially the end of last year. And when we look at the market as a bank, when we're bringing companies to market, we consistently see that there is a lot of demand for green assets. There's just not enough supply. And so what that does is that bids up new IPOs that are coming to market, new financings for green assets. It really oversubscribes all those assets. So I think that piece is certainly going to continue. There is a tremendous amount of assets that are waiting. There's just not enough opportunities to deploy those assets in. And so I think with the green taxonomy, what that will do is just make it clearer. It will just make that whole conversation easier.
It'll just make it easier to put money in and understand exactly where. And actually, it's really curious that that influx of money happened during the time of COVID, essentially. Do you think that there was overlap or correlation, cause and effect due to the COVID pandemic, or did that ETF, hockey stick happen because the market was ripe?
I don't know. I think driving, looking at regressions and driving causality is always a difficult, somewhat dangerous exercise. I don't know. I wouldn't profess to say that because of COVID, there's been more focus on ESG funds. I think that there just has been a realization of the non-linear nature of events. So we are very, in our economies and in financial markets, we plot everything and we look at everything based on historicals, and then we project linear growth in some way, shape, or form. That's the way we think of the world. I think the tech sector, if there's anything we've learned from the tech sector, it is that growth is nonlinear. And I think what COVID has shown people is that catastrophes are nonlinear. And so a lot of stuff that we take for given and we think that, okay, there's climate change, and then gradually over time, the economies will adjust and companies will adjust, and there will be time and it will all be linear. And that complacency that comes with a linear growth went out the window. And this idea that you can have step changes, and I think McKinsey did this incredibly good analysis where they were looking at kind of step changes. So what happens to a human being when the average weather or average temperature goes from 40 degrees to 42 degrees? And what happens to an infrastructure? So let's say, think about a rail station. If there is a flood of 1 meter versus 2 meters versus 3 meters, what does that do to the infrastructure? And it's all nonlinear. And I think that expectation that you can actually enter a paradigm shift world, which is nonlinear, probably had something to do with this big focus on ESG.
That's really fascinating. Now, when you start thinking about these nonlinearities, let's go into retail for a little bit. Basically thinking of the likelihood of developing carbon-free products. And we want to look at then where the opportunity space sits. But when we look at what do you think are the likelihood of developing products with lower carbon footprints and having that being much more broadly adopted, especially following the announcements of companies such as Unilever and other companies like that?
I think, so my personal opinion on creating kind of low carbon funds, where you're looking at, for example, the carbon footprint of the underlying assets, has a role to play in the wider ecosystem. I wouldn't say that is all you do, because in some ways that is somewhat of a lazy approach. So I'll talk about, for example, cement manufacturing. So as you know, under French Article 173, many of the funds are required to disclose their carbon footprint. Increasingly in Europe, we're seeing lots of local regulation that is requiring the disclosure of carbon footprint. And many investors are disclosing these carbon footprints, even if they're not required, as a way to market their ESG funds. And the easy thing to do is to get rid of the 2 or 3 cement manufacturing names from your broader universe and say, et voila, you know, my carbon footprint has gone down significantly. And look, my return hasn't suffered because, well, that was such a small part of my portfolio. So of course my return hasn't really suffered. And that to me is a lazy approach, because what you're doing is you are taking away capital from industries that need that capital to help them decarbonize. The flip side of that argument is that when that happens, a lot of companies who are in those sectors start to feel the pressure. They start to get very scared that they are going to become uninvestable in time. And that lights a fire under them to start investing in decreasing their carbon footprint. So what started as a somewhat, simplistic exercise from a fund manager can actually have real world outcomes for many of the industries. The challenge is that when you push that to the extreme, that then becomes counterproductive. So if you really dry up all capital for a company, then that just drives, I guess, costs up for that sector, and that sector becomes unviable. And then that can have real world outcomes. And so we have to think about, all of these decisions carefully in terms of, how we actually think about that. I think tobacco is another example where, historically, CalPERS, for example, came out of tobacco in the early 2000s, and they were continuously sued for years because of the returns they left on the table because tobacco stocks did well. Fast forward now, tobacco is becoming really, really uninvestable in large parts of Europe. And so you can say, yes, finally that is making an impact and hopefully the tobacco industry will shift. But it's something that you need to think about and do with caution and understand what the real world impacts are. In many cases, there can be positive real world impacts because you're incentivizing the company to do so. But in other cases, especially in the case of, for example, oil and gas and cement and auto, where you still need that infrastructure to avoid disruption, we just have to think about those questions a bit more carefully.
Yeah, and it definitely talks to the issue of you can cherry pick a EFT and make it green, but that doesn't reflect the broader economy. And if we're trying to decarbonize the economy, we really need to take into account the activities of the broader economy. And so, when we look at some of these different activities that we've talked about, whether it are things like transparency and disclosure versus things like taxonomy and regulations. In New Zealand, they're just debating laws right now on transparencies of climate risks. And from your perspective, how does the transparency and the taxonomy play with each other? Do you have a preference for one versus the other? How does that system work?
So I think that's a really good question. I think transparency is, of course, welcome, but we also know that too much data is not necessarily better data. And so what is important is, and especially from a corporate perspective, corporates want to know what is decision useful information for investors or for regulators, but they don't want to get into this kind of bureaucratic mess of disclosing a lot, and that is then not used by anyone, because that doesn't help. That's just an inefficiency. And so I think that's where much of the focus is. So for example, SASB, created a materiality matrix for, many of the industries. And that was an asset owner, asset manager led effort in order to help corporates understand from an investor perspective, what are the material ESG issues that companies should be disclosing to us. And I think with TCFD, there was a lot of flexibility that was built into it to let companies decide how they want to actually disclose those pieces. So I think frameworks are really important because for a lot of companies, and especially, I'll say all companies, big, small, ESG for many of them is a newish thing. Historically, when they think about ESG, they've thought about things like health and safety, avoiding environmental fines, avoiding labor unrest. So they have thought of ESG as a very operational thing to decrease, operational stoppages and things like that. So I think that's where many of the corporates come from. If you want to move them from that very operational view of ESG to a much more intentional view of ESG, where they are thinking about the, as the EU likes to call it, the principal adverse impacts that they're having on the environment and on the societies that they have, then you have to give them a framework on what the parameters are for that. And I think that's where the EU is at the moment, the Commission is at the moment, on trying to figure out, and there's a lot of conversation, debate around what those principal adverse impacts would be, because we are moving to a world where ESG is increasingly being used to capture the externalities that are not priced by the financial markets. And the use of regulation and disclosures to be able to capture those externalities for better financial decision making.
That's great. And, it goes to show, I think, where some of these potential opportunities might lie, going from historical operational compliance to now basically trying to influence future capital decisions and future investor decisions. You need to start creating that feedback loop of where that data flow is. And so building on that, how do you see banks basically playing within the various different technologies that are these new opportunities? And how are you thinking of which ones are the future opportunities to try to, to support?
So I think banks are not in the business of picking which technology is going to be the winner of the future. If you think about the role of a bank, the bank is merely an intermediary as a way for companies to access capital. That's what banks do. And that may be capital, which is bank capital, or it could be interfacing with the capital markets and getting investor capital into companies. So that's where banks play. I think it's much more the world of VC, private equity, where they, can be a lot more risk-taking to figure out what technology do they want to bet on, which is going to be the future. So I think we don't have a strong view on this technology versus that technology. That's not the view we take. I think within our research function, we analyze those technologies and we look at them on their merits, and we look at which companies are leading, how well they're capitalized, and how technologically advanced that particular technology might be to achieve scale. And so they're looking at it from a financial perspective to see, is this technology something that can be deployed at scale at a price point that is going to make sense? And is the structure sound enough for this to be financeable? And who's playing into it? So is it the oil and gas companies who are increasingly incubating new technologies because they are thinking about how to decarbonize their portfolio? Is it their VC arms? Who is doing that, and what is the longevity of that? Because at what point do they actually become profitable? How long does that take? And depending on that, that changes their risk return characteristics and makes them investable or not investable. And figuring out where on the capital stack you can invest. So I think that's kind of the view where banks come in, but it's really up to the broader, I'll say, more risk-taking investor community that is figuring this out. And as we know, many of the largest oil majors and metals and mining companies and auto manufacturers now have a VC arm that is, investing. I know Anglo American, for example, has a big arm that invests specifically in hydrogen, and many others are doing the same.
Right. Yeah, it's interesting to hear how it's a lot of these oil majors are starting to invest in decarbonization and trying to figure out where they fit in, especially as they're seeing the market change in terms of their wants and needs from the investor side. Now let's talk about how ESG gets embedded into some of the activities within, the banking sector. Does JPMorgan, or how does a bank essentially integrate ESG into the various different functions of the assets or the funds, especially when there's so many different standards available, and not just standards, but also reliability of data. The data that is coming sometimes is standardized, frequently it's not, but then which standard is it standardized to? How then do you take all of this data together and then put them into the banking functions?
Yeah, I think that's a really good question. So as a bank, like I said, we are a financial intermediary. So what we are in the business of is providing advice and creating solutions to help our clients access capital. And there's a lot of ESG focused capital that's out there. So for a long time, and I'll say starting from the early 2000s, we have had a risk function, environmental and social risk function. And what they do is they look at the environmental and social risk of many of the financings that we do. And so that could be, it tends to be primarily in the more extractive sectors. And we are signatories of the Equator Principles, which are broadly based on the IFC performance standards. And so what that means is that we follow that kind of like external industry guidance on what sound environmental social due diligence looks like when we do project finance for our businesses. And we also use that to generally guide our broader risk effort within the entire bank. So whether it is lending, whether it's underwriting, that's kind of the framework that we use. And then because banks are quite non-homogeneous entities, different parts of the bank incorporate ESG in slightly different ways. So within our DCM franchise, for example, where we are number one in terms of green bonds and sustainability-linked bond issuance, we have been working very closely right from the beginning in terms of kind of creating the green bond principles and the sustainability-linked bond principles to create industry standards that not just us, but others can use in terms of disclosures that we expect from companies that we bring to market to raise those financings. Now that piece is now expanding to loans, leverage loans, convertible bonds, and even derivatives. So, last year, for example, we came out with our first sustainability-linked derivative, which linked the sustainability-linked KPI into the financial derivatives that were used to hedge the bond. And so we rely on these broader frameworks, the sustainability-linked bond principles, to be able to assess whether we think that this is good or not. I think we want whatever methods, principles we use to be industry principles. We don't want to be the ones unilaterally coming up with our own version and then someone else does. Because what banks want to do is they want to create standardized products. That's what banks are in the business. You don't want one bond to be different from another bond. You want as much standardization and as much mainstreaming as possible. And so that's what we do. Another big part of what we do is ESG advisory. And so we work very closely with all of our banking functions in advising corporates in how they can be more sustainable and how can they access ESG focused capital. So for a lot of that advisory work, we use, again, external frameworks like SASB, like GRI, like TCFD, to advise how companies can think about their reporting and then use that to try to get, for example, a better conversation and hopefully a better rating from the ESG ratings agencies. So looking at how MSCI will rank a company or how Sustainalytics will rank a company. And so again, it is very, because it is capital markets focused and we are trying to bring companies to market with that kind of focus, we necessarily rely on a lot of kind of external industry-led efforts. The one final piece I'll mention is last year we created a new Center for Carbon Transition. And the rationale behind creating that team and that effort was to work closely with our clients in helping them in their decarbonization trajectories, but also understand as us, as a bank, as our balance sheet, what the climate risk was on our balance sheet, and how over time we can decrease our carbon footprint when it came to financed emissions, for example. And so that is a piece of work that is ongoing. We are working with external consultants to figure out what should our strategy be when it comes to our balance sheet and our underwriting efforts. And I think that's something that in time we are going to publish as part of our ESG report that is expected to come out in May this year.
That's fantastic. And, for most of the conversation that we've been talking about and looking at these opportunities, a lot of these climate change and environmental risks, they are part of the global north in terms of the geography of where people are putting their attention to. If we start thinking about social inequalities and diversity, how does that become a priority for the global south? And what can we do about aligning these ESG priorities from that perspective?
I think that's a really good question. And one of the concerns that was phrased quite early on, especially within the emerging market space, was if you were to rank, for example, on various ESG criteria, various countries and various companies within those countries, you would generally overweight the Nordics and you would underweight EM. And then that opens the question of, are you therefore then basically creating another excuse to drive capital flows out of EM into developed markets, where of course they have better environmental standards, of course they have better corporate governance standards, and what does that actually mean there? And I think that's where this conversation starts to get quite interesting, where it intersects with ESG and impact. I think it's at the cross section of ESG and impact, and what we are beginning to see is a lot more intentionality when it comes to impact. And this is driven by the largest asset owners in the world that are beginning to say, well, ESG is fine, but we want to see where on the ESG as a risk mitigation tool, ESG as a position for the opportunities of the future tool, and ESG as a way to create impact tool. Where on that spectrum do you actually sit? And a lot of asset owners will ask that question, and the answer will be different based on the type of fund it is. So if it is I'm going to mitigate controversies because I invest in 5,000 companies, that is going to look very different from saying, okay, well, this is a dedicated fund where I'm going to achieve environmental impact and do so at scale. What's been interesting is we are beginning to see a lot more public and private sector collaboration, especially in that space. So a couple of years ago, we created one of the first CLOs post the financial crisis that looked at channeling money into emerging markets, specifically for microfinance loans. And it was a CLO, and it was not a fund. And the whole purpose of doing something like that was to be able to bring together, so we brought together OPIC, the US entity, to be able to de-risk some of the private sector money that came into that, to differentiate the risk reward in order to create more capacity for lending into emerging markets. Amundi did something similar with their One Planet Fund, which was basically focused on green in EM. And the idea there was, again, to incentivize capital flows into EM financial institutions that are supporting green projects. And again, IFC came in and took the first loss tranche, enabling many of the other private sector investors to come in and make it tolerable from a risk return perspective, because IFC was taking the first loss tranche. So I think there's a lot of innovation that is beginning to happen with that kind of private public sector collaboration, specifically for impact. And I think that is something that is expected to continue.
Yeah, and certainly the IFC is well known. World Bank IFC started the first green bond, 2007, 2008, something like that. And so they're definitely well positioned to be able to take that first tranche risk and try to de-risk some of these future opportunities. I want to go back slightly into what you were talking about at the beginning of this, which was how there's different uses for ESG. And you were talking about how different investors have different uses for ESG, because that leads to this question that someone put into the chat box, which is, it talks about standardizations of ESG reporting. And it strikes me that if there's different uses for ESG, shouldn't there be different standards for ESG? But then yet at the same time, it feels like we're also inundated with standards of ESG. And do you see a conflict of, are these all of these ESG standards going to converge into a single standard? Or will there always be a handful of a couple, and that's just because there's different uses for this ESG tool?
So I think of this as accounting standards. So accounting standards, think of a world before accounting standards. And there was a lack of comparability. So even before you think about use cases, you have to think about comparability and reliability of data. And so what standardization does is gives you confidence and comparability across multiple different assets and different companies. And I think that's really, really important and key. The use case can then come from that, because nothing is stopping an investor from asking a company to provide additional information. And they often do. And they often do in investor roadshows and bilateral investor meetings. And that certainly happens. But what the standardization does is it just creates a level playing field. So you don't have these discrepancies where generally European large cap companies have a better ESG score than US large cap companies, just because they have more disclosure, or large cap has more than small cap, and developed markets certainly has better than EM. So these kind of discrepancies hopefully can go away in a way if you create a level playing field of disclosures and standardization, where you say, okay, there is one page. I mean, my nirvana, my ideal world is, one page in every annual report that says, here are the 5 material ESG issues for my sector. Here is the 10 KPI I track as a result of this. And this is what it looks like. And I can show you a trajectory over the last 5 years of how I've made improvement or not. And if I can actually do that, then that will just really be a game changer for many of the companies. And I think this is where the world is kind of moving to. I really don't like this idea of many standards, because like we said, more data is not better data. It's incredibly confusing for corporates. The number of times I've had conversations where, like, should I do GRI? Should I do SASB? Should I do something else? Like, what does that mean? EU taxonomy? How does that fit in? How does CCFD fit in? It takes away time and energy from what companies know and do best. It's much easier if you just give them a North Star and say, this is what you're supposed to do, and go. Much more efficient.
Great, thank you. And we're getting close to the top of the hour again, and we know we have a very engaging speaker when I prepare about 24 questions and we get through 2 of them, and the rest were all produced by the attendees. So thank you very much. But I will have the last question, which is, based on now you working in the sector for so long, where do you think is the biggest need for future expertise?
Climate. I think where we have the biggest need for future expertise is the intersection of climate and financial markets. Because one of the things that I observed when I moved from financial markets to this kind of ESG function was that there was a lot of expertise in sustainability that was deep, that was, came from kind of consulting, risk, backgrounds, came from NGOs, policies. There wasn't enough financial intermingling of that, and there wasn't enough real kind of climate expertise in that, the so what. Because what we don't know the answer to, and I face that repeatedly, is so what? If you did this, so what? How would that actually make an impact? So what I would like to see is significantly more interfacing between the climate scientists, who do a lot of modeling and know the answer to so what if this were to happen, to talk a lot more to financial experts who can translate the so what, in a language that financial markets and corporates can actually understand. Because I think that interface is not happening adequately enough at the moment.
Fantastic. Well, thank you for that little bit of advice, and very good to know that is hopefully where future training and future expertise can come out of. To those of you listening, Thank you so much. Neha, thank you for your time. Oxford University, Said Business School, and the team running the technology behind the scenes, thank you so much for making the webinar flow smoothly. Please feel free to join the SBS Alumni in Energy Network on LinkedIn to continue these discussions. You will receive a 1-minute survey shortly by the email that you registered for this event so we can gain some feedback. And just a quick plug for the next event, which will be on Monday, 19th of April, on navigating the new retail landscape. And that's going to be with Professor Jonathan Reynolds, where he and an alumni panel will look at how retail leaders can address their profound financial, structural, and spatial consequences of adapting to the post-COVID society. So again, Neha, thank you. Business School, Said Business School, thank you very much. And this is Jimmy Gia signing off.
Thank you, Jimmy. And thank you for the opportunity to be back and speak to this audience. Thank you.
Thank you for your time.